and welcome to our second last session for the day, a session in which, as it is usual by now, we will formally recognize the winners of the best law and best finance paper for last year. I would like to say a couple of words because Marco and Guido reminded us that this all started in Milan at Palazzo delle Stelline. I wanted to say that it was my first conference of economists. Until then, I only had attended lawyers' conference, and what impressed me most was that they used transparency, which was high-tech at the time. And people in this room may not even know what these things are. It felt very, very, very cool. But that was 25 years ago, and now we have had ECGI for 20 years, so we would like to take a moment and remember the last 20 years. Have a short video should start. So we will start with the finance prize, and we have with us on my left Ms. Tagliavini, who is board member of Intesa Sanpaolo, who has generously decided to sponsor this year's prize. And Ms. Tagliavini is chair of the Risk and Sustainability Committee of the bank. And on my right is Mike Burkart. I am reminded that until yesterday, Mike was the second most famous person from Basel. Then Roger Federer retired. So today, he is the most well-known person, at least in activity. So without further ado, I would like Ms. Tagliavini to say a few words. The floor is yours.
Just a few words. Thank you, everybody. Just a few words why we decided to sponsor the prize, you know. And this is in the context for our bank of the ESG commitment. I have prepared just a few words with numbers related to the role and the importance of the ESG for the bank, for our bank. And so if you're not aware of that, I would like to inform that Intesa can be considered as a leading model for sustainability, as is reflected by its positioning in the main international indices and rankings. So Intesa Sanpaolo is the only Italian bank included in the Dow Jones World and European Sustainability Indexes and ranked first among its peers by MSCI, Sustainalytics, and Bloomberg. And also in 2022, it was classed as the best European bank and the best Italian company for ESG aspects and institutional investor ranking. So just a few words just to reinforce the importance of the ESG seriously for the bank, okay? And here I'm just representing the bank as a board member, but also as a chair of the Risk and Sustainability Committee, which is a committee of the board, with this additional responsibility for sustainability, for the ESG. And I think that is for highlighting the importance of this topic for the bank. So within this framework, the ESG framework, for sure, the academic research is considered as fundamental for the bank, which is investing in the relation with all the universities and partnership with the main Italian ones by providing support for study and research. Numbers, 40 agreements were signed in 2021 and various partnerships all over Italy with the university, and more than 150 scholarships and research grants were also awarded to young students and researchers. So the prize, the ECGI Academic Research Award, for us means support the research, and we are pleased to award the prize to this article on proxy advisors. So now the word to you, just I have anticipated a little bit the topic of the winner, but I give you the floor just to introduce the winner.
Thank you.
Okay, no.
Thank you.
Pleasure.
Thank you. Okay, so let me start by thanking actually the members of the editorial board for the finance series, for the work they put in picking the winner. And these are René Adams, Mireia Ginei, Franklin Allen, Julian Franks, and Marco Borgano. These are the guys who are to be blamed for the winner. Now, when announcing the winner, it's not a big surprise. Not only has it been announced some months back, it's also written in the program. But nonetheless, let me repeat the title of the winning paper is Creating Controversy in Proxy Voting Advice. And the authors are Andrei Malenko and Nadia Malenko, both from the University of Michigan, and Chester Spatt from Carnegie Mellon University. So I don't want to hide this. I'm extremely pleased by the pick of the editorial board because it's a theory paper, and those of you among you who know me a bit may know that I have a slight theory bias. That's the understatement of the day. So I'm really pleased this time. It's a theory paper, and the paper, I think I like it a lot. I think it's on an important, very topical issue, namely the role of proxy advisors. And I think everybody in here knows that proxy advisors are quite sort of prominent or influential player, and notably Institutional Shareholder Services and Glass Lewis, they are providing information to lots of shareholders on lots of firms and give voting recommendations. Now, coming from my background, a sort of theory, and should we delegate this whole information collection to somebody else than yourself as a shareholder, given this party doesn't even have a stake in the firm? I get suspicious. I mean, I'm generally suspicious, but what makes me really suspicious, and obviously it poses the question, can you as an investor or as a shareholder, would you actually trust these guys, what they are saying, given they are actually not having any stake in the firm, they are in the business of selling their services, okay? And this is exactly, or putting it the other way around, given these proxy advisors are into maximizing their revenues from selling what we are selling, which is basically information and recommendation. What can we expect of these type of recommendations? Are they going to be unbiased? Is there going to be any information in it, or is it, and so on? And this is exactly what the topic the paper explores, as sort of the nice twist, and crucial for all the results we're having in the model is that the proxy advisor in the model produces two signals. One is a public recommendation, which is free and everybody can see it, and then the other one is a research report for which you have to pay. Okay, and now the basic inside, or a punchline is essentially that the proxy advisor is going to play around with the recommendation, which is available to everybody, in order to get more people to buy the signal. Okay, which I'm not surprised. I think this is super neat, and also I like it because it sort of supports my initial suspicion that something here is possibly fishy. And then, now how does this all go? So how does the proxy advisor get more guys to buy, and girls to buy their research reports? And essentially is by having a recommendation to the public signal, which is partially informative, but it is biased, and it's biased against the alternative, which a priori is less likely. Okay, so that's where the title comes from, creating controversy. And then this, because now this giving this sort of biased signal, it's going to be more likely that the vote among the shareholders will be close. Okay, given the vote is close, I'll be more likely to be a pivotal. My vote may be pivotal, which, since I care about firm value, which makes me willing to actually buy the signal. That is sort of the main insight, and that's very nice. Obviously, the research report which I get, that has to be unbiased and as accurate as possible, because otherwise it's not worth it. And that is why you get this. And just as a benchmark, if proxy advisors were really only caring about the firm value, they would never bias their recommendation. They would be just being informative of what they truly believe. Obviously, they could be mistaken on occasions, but no bias in it. So I think this is, overall, this makes for a very nice piece of applied theory on a relevant governance topic, which is kind of handy, given it's going to be a best paper prize for governance, on governance. And also the paper is not also sort of neat, it also has nice implications in terms of how we have to interpret what we see out there. So quite often you see, but one sees institutional investor or funds voting with management, even though the proxy advisor's recommendation was the other way around. And then the naive interpretation is, oh, we are just lazy, or we are in the bed with management. I suppose one doesn't say that anymore. So we are poor management, but in the world or in the framework of the winning paper, it's essentially we just correct the bias in the recommendation. Okay, and with that, I would like to congratulate the authors once more, and I'm giving over now, hopefully, to Nadia, who Elaine is now going to produce. Are you? Yes, here she is.
Nadia, the floor is yours.
Thank you so much. First, I'll just like to say we're extremely honored to receive this award. And thank you also for the opportunity to tell a little bit about the paper at this great conference. Mike has already touched upon the most important issues. I will just elaborate a little bit more on them and give a little bit more detail. So overall, the role of proxy advisors, of course, has become increasingly important given the rise in institutional ownership and the increased complexity and breadth of the issues that institutions focus on. And these, of course, includes questions related to environmental, social, and governance practices, the core of responsible capitalism. Proxy advisors provide their research to a large number of institutions, and prior work has shown that their guidelines and recommendations influence companies' practices, and that their advice has a strong influence on voting outcomes. So the strong influence has heightened the concerns among regulators and market participants about the quality of proxy advisors' recommendations. Can you see me, my sharing? Yes, I'm sorry. Can you see my sharing? I was planning to start sharing it now, but can you see it?
No.
Thank you.
It's impossible.
No?
No.
No? Can you see it now?
No.
It tells me I'm sharing. Oh, that's okay. I don't need to show the slides if you don't see them. You don't see them?
No.
Sorry, we did the practice round, it worked then. I'm sorry again. That's okay, I'll just continue. So in this paper, given the strong influence and given the concerns that regulators and market participants have raised about the quality of research and recommendations, we ask the fundamental question: do proxy advisors have incentives to produce unbiased and informative research reports and recommendations? And as Mike already has touched upon, proxy advisors provide two important pieces of information. First, all the subscribers get the research reports, which contain detailed analysis of the company's governance practices, performance, and the costs and benefits of the proposal on the agenda. These reports are private and are only available to the subscribing shareholders. In addition, these reports contain binary vote recommendations, whether the proxy advisor recommends voting in favor or against the proposal. And unlike the research reports, which are only available to the subscribers, these binary vote recommendations are often made publicly available, both by various media sources and as well by the party that is supported by the proxy advisor, for example, a dissident in a proxy fight. Now, will proxy advisors have incentives to produce informative and unbiased research reports and recommendations? And I want to mention that a common concern that has been raised is that the proxy advisor may produce conflicting recommendations because of the services, consulting services that it also provides to corporations. But there is another potential for conflicts that receive much less attention, as is the focus of the paper and that Mike emphasized. Proxy advisors face a fundamental conflict of interest because ultimately they are sellers of information, and their key objective is to maximize the profits from selling information to the shareholders, rather than the value for asset managers and operating companies. And given that, we show that the proxy advisor has incentives to create controversy. And by this we mean issuing recommendations that are biased against the a priori more likely alternative. Let me give you an example. If we think about same pay proposals, if we think that a priori likelihood that the same pay proposal is approved is high, this implies that the proxy advisor will have incentives to produce recommendations that are biased against management on same pay proposals. In contrast to recommendations, we show that the proxy advisor benefits from producing high-quality, informative, and unbiased reports. And the intuition is very simple. If the proposal is very likely to be approved, then the value of information to the shareholders is small. Even if an institution carefully reads the research report and makes a more informed voting decision because of that, the vote is unlikely to change the outcome. So the institution would then be not willing to pay as much for the research report in the first place. By biasing the recommendations against this a priori likely alternative, the proxy advisor can increase the uncertainty about the vote and increase the probability that the vote will be closed. That raises the value of information and induces institutions to pay more for the research report. And these incentives for the bias to identify are inherent in selling advice. They emerge even if providing voting advice is the only business of the advice. So what are some implications of this result? One that Mike also mentioned is that it provides a reinterpretation of the observed evidence on asset managers' voting behavior. Prior research has shown that the votes of major asset managers are often more pro-management compared to access recommendations. And one way to interpret this evidence is that these major asset managers are biased towards managers. Our paper suggests a different interpretation. It highlights that proxy advisors' recommendations may not be the right benchmark in the first place. They may be biased against management to create controversy, and then voting in a more prudent management way could be simply a way to correct for this bias. In fact, in the context of our model, the votes of institutional investors that manage large portfolios are both informed and unbiased, and in this paper, in this sense, the paper suggests that the votes of major asset managers could be potentially a more suitable benchmark for evaluating small shareholders' votes rather than proxy advisory recommendations. Another implication concerns the one-size-fits-all approach. Proxy advisors are frequently criticized for following prescriptive guidelines that don't consider the specifics of the company that is being considered. However, they keep doing this, and our paper can rationalize this approach because, as we show in the paper, this approach can help implement recommendations with context. Finally, the results suggest a particular pattern in shareholder voting outcomes, which is consistent with the observed evidence. we predict that shareholders will effectively rubber stamp recommendations that are consistent with their pride beliefs, but will not rubber stamp recommendations that go against their pride. And this is very much consistent with actual voting practices, as you can see in this figure, which plots the distribution of voting outcomes for negative and positive ISS recommendations. As the right figure shows, for positive recommendations, they're typically followed by almost universal approval, so they are effectively rubber stamped. In contrast, negative recommendations are not rubber stamped. There is a lot of discussion in shareholder votes and a substantial chance of a close vote. And this pattern is consistent with our predictions. So let me summarize. We show that the business model of proxy advisors gives them incentives to produce high-quality research reports, but also to create controversy in their recommendations, biasing them against their a priori likely alternative. And we think that recognizing the potential for this bias is important for asset managers in their role as responsible stewards of capital. Thank you again very much.
Thank you very much, Nadia, and apologies for the initial problems, but we could follow most of your presentation with the slides. Thank you, and congratulations again for the excellent paper. I would now ask you to leave. Thank you very much, Paola and Mike. And now, please, Pietro Fioruzzi and Geneviève Helleringer. No, you. Yeah. So for the second prize, we have Pietro Fioruzzi, who is a partner at Cleary Gottlieb Steen and Hamilton in the Milan office. Cleary Gottlieb is the generous sponsor of the prize for best prize for law papers. And on my right is Geneviève Helleringer, who you already know, and who is a member of the editorial board of the law series. So I would leave the floor first to Geneviève, if that's okay with you, and then to Pietro.
Okay, I'm going to be brief because we are hoping that whoever is a recipient of the prize will present the paper, but we still need to open the envelope. But here is the paper. I printed it to read it. As you might see, I had some tea or some water that was spilled on it. You can see it's a damaged paper. So this is the first paper in my life that actually grounded me to the floor, because I started reading it. Then I had some water on it, so I had to put it all over the floor in my study so that it would not dry, as a solid packet. And I literally read it on the floor, one page after the other. And why that? Because this is a paper that is written from a very different perspective, I think, that most papers we read in our field. And I'm not going to. Am I allowed to say to reveal the authors? Or perhaps Pietro will. What I can tell you is two women. One of them is a professor at the USC Gould in California, and the other is a professor in Penn Law School. And one of the authors who is present in the room and will receive the prize was actually trained as an undergrad as an anthropologist. And I think this shows from the first line in this paper. The perspective you get on corporate governance is really a perspective with a new angle. It's someone who is interested in human beings, in human structure, how human beings get organized, how the law reflects this organization, and in particular how this very interesting and specific organizations, which are corporations, are actually organized and how they work, how they evolve over time. There's three parts in the paper. The first part is about the past, so how the present, and what it tells us about what we can know about the future. The paper is quite pessimistic. I won't say more because Pietro, once he's revealed the name of the author, can be able to tell more about the substance, perhaps. But but it's quite pessimistic as far as the future of ESG and ES in particular is concerned. You know, making the bet that a really strong push will be necessary, like a structural change. And I was just wondering, being a European reader, whether the directive, you know, on the EU draft directive on the supply chain, perhaps, you know, is one of these pushes. But I won't say more, and I can hand on the mic.
So first of all, thank you for having me here. It's not that the firm is generous sponsoring this, it's selfish. And obviously research nourish the practice of law much more than people think. And particularly at times of changes and disruption like the ones we are living, I think having continuous reflection on what is happening and how the law and whatever is behind the law, as I think our scholars here reveal, is very, very important and crucial to then guiding us practitioners to have decision makers take the right decisions at the right time with the right process. So I don't think as a firm we are very proud to continue the support. We don't have to introduce the firm and its franchise, but clearly the transatlantic and global approach is crucial, and we like the idea of research done that takes into consideration the global environment we are in and some of the trends that companies face, irrespective of the jurisdictions where they are based and where they operate. So I think we need now to hear from the horse's mouth what all of this is about. Just one note, corporate purpose, which is something that we'll hear very much is in a moment is something that to scholars of our generation, Luca, right, is something we care very much about. But what is very, very in a way new is that this is at the time of corporate social responsibility migrating into ESG, helpfully as you described. It is crucial to our daily practice and the daily debate that we witness on boards of the organizations we advise and we all see acting. So I think it's a very original piece of work for the reasons Geneviève said. Geneviève said it's a paper that is pessimistic. I say it's a pragmatic piece of work because it clearly indicates what the direction also of the approach that we advisors to the board can and should have on dealing with the issue of corporate purpose. And I think we should now hear from the researcher's voice. And probably I need to announce who she is. Elizabeth Pohlman here with us, co-authored with her colleague and friend, Dorothy Lund. Please.
Thanks. Well, it's late afternoon, and I think I might stand. You know, on behalf of myself and my co-author, Dorothy Lund, I give my heartfelt thanks, and Dorothy's as well, to Clary Gottlieb. It truly is generous support, and it is valuable and meaningful to give this kind of support towards academic research and to have this kind of interchange as well, so that we can have these dialogues and see where this world goes. Thank you, ECGI. I have been reflecting on what a marvelous institution this is. Thank you, ECGI, for creating and cultivating this amazing international community. In the past couple of years that I've gotten to be involved, it has been one of the real highlights of my scholarly activities. It is really an extraordinary group that I learned from so much, including yesterday and today. and I'm just inspired. And I say that on behalf of Dorothy as well. So thank you all so much. And now I will share with you a bit about the paper. So the paper is called The Corporate Governance Machine. And I've been reflecting on it. And it really started out of a conversation that Dorothy and I had a few summers ago about the corporate purpose debate. And there was increased attention. We noticed that it tends to focus on what business leaders should do to run companies, or typically what corporate law and fiduciary discretion allows and the objectives. But despite a lot of talk, we were still seeing existing patterns being quite sticky. And the very debate that was taking place about it was happening in kind of somewhat predictable ways. We could kind of intuit what was going on. So for example, the Business Roundtable statement provoked the Council for Institutional Investors to respond, and so on. And we see this not only with the corporate purpose debate, but with other examples as well. Pretty much any time there is a debate in the US about a corporate governance reform proposal, whether it's conflict minerals disclosure or a reform to shareholder proposals, or when companies stray from the usual path, such as by using dual-class stock, we start to see these sorts of patterns. So Dorothy Lund and I wanted to take a step back together. We really loved collaborating on this project. And we wanted to give kind of a meta account of the system of US corporate governance with particular attention to public companies. And as mentioned, we wanted to look to the past and the present and the future in the project. And essentially what we're aiming to show is that in the US, we have a system of corporate governance that's more than a neutral set of procedures and processes. It's really become a system that's composed of multiple legal and institutional players. And what we try to do in the paper is give an account of the law and the institutions and the culture that make up our system of US public company governance. And we show that as this evolution has taken place to form this system, what we call the corporate governance machine, it's developed a strong orientation towards shareholders. And that, of course, has implications for the contemporary corporate purpose debate, but it also has application to other debates in corporate law. And we look at the consequences of the corporate governance machine's workings, and we suggested it might be suboptimal, because when shareholderism is locked into rules and norms and power structures, and that gets imposed across companies through best practices, that might impact corporate governance innovation and diversity. And we show how soft law and legal reform itself gets filtered through this shareholder system. And we argue it's shaping the regulation and the expected path of reform. So for example, even moves towards incorporating stakeholder interests is happening through a system that gives shareholders primacy. And so we conclude with some observations about the likely futures for US corporate governance. The paper is divided into 4 parts. So today I'll just briefly highlight a few parts about each. So we start with the past. And the part 1 of the paper traces a convergence of 2 things: the rise of the term corporate governance alongside the rise of shareholder primacy. And so the term corporate governance, it was initially coined in the 1960s by a business ethicist, Richard Eels, who was arguing for a well-tempered corporation that would serve society. And the term then appeared again after being used by this ethics professor in the New York Times in 1972, about a decade later, in the midst of a series of corporate scandals. And initially, it was stemming from an analogy between the government and the corporation, and suggesting that limitations on corporate misconduct could come through internal checks and balances. So it was an analogy to government checks and balances. And during that period of the 1970s, there were hundreds of public companies in the newspapers pretty much every day for corporate misconduct. For different reasons, both the political left and the political right in the US embraced this analogy of controlling managerial power through internal government-like checks and balances. So Ralph Nader, for example, argued that the private governments of the mega corporations should be more democratic and responsive to public needs, and he would use the term corporate governance. Around this time, we also saw academics like Melvin Eisenberg introduce the concept of the monitoring board. Jensen and Meckling injected the economic concept of agency costs into debate about corporations. The divergence of interest between the shareholders and the corporate managers became agency costs to be minimized, and those voices were the ones that started to prevail. The deal decade of the 80s locked in this normative overlay that started to develop over those thinkers of what constitutes good corporate governance. And that was serving shareholders to minimize agency costs and maximize shareholder value or wealth. And by the end of the 80s, shareholder wealth maximization had moved into the mainstream, influencing corporate boards and management. And critical perspectives received labels like progressive corporate law and stakeholderism. So in sum, while the term corporate governance had initially been used to invoke the notion of a well-tempered corporation, consistent with the ideals of a democratic society, it was embraced in the 1970s by those both taming the giant corporation for the public interest, but by the 80s, louder voices were starting to prevail in focusing the term's meaning instead on reducing agency costs, maximizing shareholder value and wealth, and then it was viewed as kind of good corporate governance and bad corporate governance through this lens. So shifting to the present, in part 2 of the paper, we explain that intellectual legacy is at the foundation of our contemporary corporate governance system, and there's really 3 kind of components or reinforcing parts. There's law, institutions, and culture. So because many of these components will be very familiar to this audience, I'll just be very brief to highlight a couple points here. So on law, Dorothy and I include Delaware, Congress, the SEC, and the Department of Labor. So that's including all 3 branches of government in the US and federal and state level. In institutions, that part discusses the players in the market for corporate governance. Many of them have rules or voting policies or play an important role in furthering those or doing advocacy. And we're all, I think, in the room quite familiar with that sort of thing. And that includes influential investors such as mutual funds, hedge funds, pension funds, investor associations such as CII, industry associations like the Business Roundtable, proxy advisors, stock exchanges, stock indices, ratings agencies. They're institutions part of a market on corporate governance. And then third, we discuss culture. And I think in many ways, this is the most interesting and most difficult to pin down aspect of our system. It can be created and transmitted through a wide array of actors and institutions. We focus on the role of professional education, both law schools and business schools, media, and politics. And we show how each of those components further reinforce a shareholder primacy viewpoint. So in sum, the part 2 of the paper is setting out the law and the institutions and culture that form our corporate governance system in the US, and it describes how each of these orient towards shareholders. In concluding that part, though, we have a little coda in which we note that culture appears to be in flux. And academic institutions are increasingly teaching different viewpoints. Prominent scholars and professionals in business and law are likewise calling for change or rethinking. Media outlets are increasingly observing a shift away from shareholder primacy taking place. Political parties have begun to attack shareholder primacy. So we're seeing some movement here. And we open the question of whether cultural change might manifest a shift away from shareholder primacy. But we note that it would exist within this system. So let's talk about how this works. So in part 3 of the paper, we thought it was important to not only set out the components and how they orient towards shareholders, but also to show how their dynamic interaction is shaping US public company governance. So we give 3 examples in this part. The first example is public company boards and composition. The second example is the shift of dialogue from CSR to ESG. And then the third example is benefit corporations. So on that first example of public company boards, we describe how these boards shifted from the mid-20th century managerialism to a monitoring model that started in academia in the 1970s. And that promoted the view that the chief function of the board was to monitor management for the benefit of shareholders. That idea that came out of academic research was then endorsed by the American Law Institute in its Principles of Corporate Governance. And then it was embraced by the SEC and then the ABA Committee on Corporate Laws. The hostile takeover wave of the 1980s and the law from courts then during that time further solidified the development. After the Enron and WorldCom scandals, the New York Stock Exchange convened a corporate governance task force that generated strict director independence requirements, and then Congress adopted the Sarbanes-Oxley Act of 2002. Proxy advisors then incorporated those ideas into their voting guidelines. So these legal and extra-legal changes led to a dramatic shift in board composition across US corporations. What had been in the 1950s of 20% independent directors on US public company boards rose to 75% by the mid-2000s. And that was so despite the fact that there is not conclusive empirical evidence that director independence leads to better board decision-making, oversight, or firm value. So that shows, I think, how ideas that start in academia could be furthered by major institutional players, including the SEC, the stock exchanges, influential proxy advisors, adopting rules that brought the monitoring model into the mainstream. And by force of those developments, all US public company boards have a significant percentage of independent directors. And that's true across different industries where we might not otherwise expect that. And they typically view their role as safeguarding the interests of shareholders. The second example that we give is the evolution of discourse from CSR to ESG. In the 1950s, before the agency cost and shareholder primacy view of corporate governance was taking over, CSR, if you go back to the original first discussion of this in the term CSR, it was framed in moral terms, and it was totally unlinked from shareholder value. It was an idea that corporations would have a social obligation to engage in responsibility because it was the right thing to do. But by the 1980s, a shift began to take place as CSR models began to rely on trying to show a link between responsibility and financial performance to make the business case for CSR. Researchers began working on that quite intensely. And over time, that accelerated by the 2000s when the concept of value-oriented ESG became coined through a United Nations conference that brought together institutional investors, financial analysts, consultants, regulators, and that reframed and helped enable ESG to hit the mainstream. For one, value-enhancing ESG, the claim at the outset of the term ESG was that there would be an alignment with long-term risk-adjusted shareholder value. That made it consistent with law in Delaware, which meant that legal actors and scholars could embrace it. Not only that, market players could realize that they could supply metrics and services for fees to help companies report, investors to evaluate ESG performance. ESG became a business opportunity too. So this second example shows how the corporate governance machine, the system, takes a concept that's unlinked from shareholders and through law and markets and culture reshapes it, creates a new concept tied to aligning with shareholder value, and in doing so allows and helps enable it to go mainstream. The third example is benefit corporations. And this one is closely tied to the second. So to the extent that a business wants to pursue profits and a social purpose at the same time, that is seen as inconsistent with shareholder wealth or value maximization, it now has a customized option that came about in the 2010s. Organized as a benefit corporation, or what's known in Delaware as a public benefit corporation. And we point out that that new form of business organization is a 21st century reflection of how the corporate governance machine pushed corporate social responsibility into an entirely different form of corporation in many ways. And even the benefit corporation, the structure of it, is still subject to the forces of shareholder power. So that's part 3. And finally, part 4. Part 4 is about implications and the future. So we have a sense of the history and the components and the dynamics of this US system. what are the implications and what can we say about the future? It's always, Adolf Berle said it was dangerous to make predictions, but we got to try. He said it a little bit more formally. But the first thing that we know is that this system that we have, it does have a number of implications that you can start to see, and I think many of us intuit that this is shaping corporate regulation. So we observe that this is shaping the manner of even how people advocate for legal reform, because that's strategic to do it that way. So in the US, with the current debate about ESG disclosures, even advocates in favor will focus on information that is material to investors. And a similar pattern emerges in practice and soft law norms too. So for example, with voluntary ESG disclosure standards, as they are gaining adherence, we're starting to see the flexible, more shareholder-oriented SASB standards winning out in the US in many ways, despite the fact that the more stakeholder-oriented GRI have existed longer and are popular elsewhere. And the fact that legal reformers work within the language and the conceptual framing of shareholder primacy is solidifying a cultural understanding that corporations exist for the benefit of shareholders. So to the extent that then legal reform further strengthens shareholder power, there's a reinforcing effect that's happening that's further locking in the corporate governance machine's orientation and the players who are perpetuating that dynamic. We also think that this system tends to push towards one-size-fits-all governance for various reasons that we explain in the paper, and that can tend to hamper innovation in corporate governance too. So despite, for example, any consensus about universal good governance practices, many firms get pushed towards best practices. And that could be independent boards, split board chair and CEO, majority voting, no standing poison pill, pushback against dual-class stock. We kind of all have seen this and intuit this. And ultimately, we think this issue deserves additional study. But in this paper, we're observing that the operation of this system tends to push towards giving a kind of governance blueprint for vastly different types of firms. It's also shaping the public and private divide in the US, I think. We see a greater diversity of governance arrangements in private companies, like venture-backed startups, for example. Those companies regularly depart from corporate governance machines' kind of precepts. They have, in many cases, unequal voting rights, founder-dominated boards, and other kind of bad governance characteristics. And those have been seen as tolerable, even necessary to protect high-growth, innovative companies with visionary founders or companies that want to stay true to a mission. But once they decide to go public, there will be scrutiny. There'll be scrutiny from institutional investors, ratings agencies, investor advocacy groups, stock exchanges, indices, proxy advisors, and then the various pressures and preferences that come with that. And in an environment where there has been, at least up until recently, a lot of private capital available, this also may be contributing to the trend of companies staying private longer. Why go public when you're going to subject yourself to this corporate governance machine? And the startups that have visionary leaders and market leverage push for dual-class or multi-class structures to try to insulate themselves from this. And in doing so, they've actually been one of the few sources of governance variation that we've had injected into public markets, notably in recent years. And we also highlight that the corporate governance machine might also affect the balance of whether certain activities are being performed by large public companies rather than smaller private ones like research and development. And then the future. Well, this is always the dangerous part. We observe that once you have shareholder orientation getting enmeshed in our legal and institutional and cultural understanding of what ideas of good governance are, and as you have multiple powerful players operate like gatekeepers, it just becomes more difficult to move to another paradigm. So this is in many ways not a normative argument. It's an analytical argument about what we're seeing come together. And it becomes difficult to move to pretty much any other type of paradigm that would give power to other stakeholders or allow corporate executives to make decisions based on the corporate entity or overall social value or welfare or something else. And so we think that without a substantial shock to the system, we're probably unlikely to see a really significant change, because you'd have to change multiple components that are working in a dynamic together. So we think, at the moment at least, it looks like stakeholderism is unlikely to dethrone shareholder primacy as the dominant framework in US public company governance. Instead, the system that we have is pressuring advocates for that to fit their models and ideas and proposals into the existing infrastructure, and we are seeing that. That's this process that's been playing out for the past decade or two now with the rise of ESG. And as shifts in understanding occur about the merits of various ESG initiatives, and better metrics might develop for measuring those, maybe a greater level of stakeholder interest can be reconciled with pursuing long-term shareholder value, and so it can be reconciled in a way that there is change in this system. And ESG, as I noted, could be also a business opportunity for asset managers, proxy advisors, rating agencies, et cetera. And so they embrace ESG activities that could be, especially ones that could be easily measured or scored for investors or perhaps even public consumption. So we think that likely in turn will start to also shape the types of ESG activities that we continue to see and that companies choose to engage in. Over time, as market players start to develop more detailed or sophisticated metrics and products for companies at scale, we might see also that the corporate ESG activities also tend to take a one-size-fits-all pattern as well, in some instances. So this is a story to be continued, of course. I will end on that note. It was offered in the spirit of trying to capture this very complex system that we have in the US, a dynamic system, but one that really has, over time, developed in a way that is oriented towards shareholders, and that really does have significant impacts in the world. Thank you so much. I really appreciate it.
So now is the time for the formal prize giving, and I think for a picture as well, after which Marco will take over.
I think after this forceful presentation, we feel even happier with awarding Professor Pullman the Clary Gatvik Prize for the best paper in 2022.
Thank you so much, Pietro. Thank you so much, and from Dorothy Lund as well, we both thank you so very much. Thank you for being here, Pietro, to do this in person. It means a lot.